Continuing looking at expectations for next year, according to market analysts, the growth outcomes for 2022 were far more stable compared to the historic volatility of 2020 and 2021, which saw the deepest global downturn on record. However, looking ahead, investors expect good and bad news for equity markets and more broadly risk asset classes in 2023. I caught up with David Nee, who's the Chief Investment Officer at M&G Investments, to review the year for 2022 for the markets.
After COVID in 2020, I thought that there was little that could really kind of grab us by surprise. And then 2022 came along, and on the 24th of February, Russia obviously invaded Ukraine, kind of upending, close on 70 years of post-war peace. So, that was potentially a seismic event in geopolitics, and markets are wrestling with the implications thereof. At the same time, we've had 40 years of declining inflation and declining interest rates, which have generated overall fabulous investment returns for investors, which also we're asking ourselves, has that era come to an end and we're facing a different environment in terms of those long-term rates and inflation. So there were certainly a lot of surprises in 2022. We came into the year looking at particularly the South African market and thinking there were some really exciting and attractive investment opportunities. And we were positioned for those in a relatively modest way because COVID did introduce a lot of uncertainties in global supply chains. And there was a long-term question about the transience of inflation. And so we were overweight risk assets. And the year has been one where we've just seen huge volatility in those asset prices. But I think we were right in favouring South African assets over global assets, and we can talk more about that, where to from here. Despite kind of high and rising inflation and high and rising rates, then actually asset performance has been better than I think one would have expected in those circumstances.
What surprised you the most about the year?
Yeah, I think a couple of things. One, the invasion of Ukraine, not that anyone ever kind of expected that at all, but just the upending of effectively an arrangement that was struck when Russia came out of the communist era in 1990, where it was admitted into the global trade system in exchange for agreements that it would sustain the peace. To turn that upside down with the invasion of Ukraine was a huge surprise. So in geopolitics, that has to, I think, be forefront. In terms of macroeconomics, then it's been the persistence of inflation and the shock that that's brought to the system. Having had, I don't think there can be many people that are working in markets that experienced a high and rising inflation environment in the way that we've seen in this past year. It's really brought to an end 4 decades of falling and relatively benign inflation. So, I think a lot of investors felt this year very out of their depth in terms of what the implications for markets were. And that is something which obviously has contributed to the volatility. But if I was to highlight 2 things, it would be those.
So it's quite interesting when you listen to some of the comments coming out of Fed Chair Jerome Powell and various market participants, especially when it comes to their expectations going into 2023. What would be for you the telltale signs of a recession in the US?
Yeah, a lot of them are already there in that if you look at the confidence surveys, business confidence, or consumer confidence, they've been absolutely smashed this year, particularly the consumer. And, that has created a little bit of a conundrum because clearly the labor market in the US and across the Western developed world, those labor markets are incredibly tight. So historically, the main driver of a weakening in consumer confidence has been rising joblessness. And the uncertainty of that brings on household income. Whereas this time around, household income actually has been pretty robust. The fiscal giveaways and the checks sent through the post to workers through COVID, the furlough schemes that were put in place in the UK and in other countries, actually left households coming out of COVID in a pretty healthy financial position. And yet at the same time, they clearly feel very worried about the future. And inflation has eroded real wages, so that's one component of that. And I think as well, uncertainty, the geopolitical uncertainty is another aspect. And then, the long-term future for interest rates, a lot of column inches in the press about, what's happening to people's mortgages and the affordability of their debt. It's clearly a very different phenomenon if you're borrowing to fund your house at 3%, in pounds, and then now suddenly, if you're having to remortgage, you can't find a deal that's better than 6.5%. So, all that uncertainty seems to have combined to create, a lot of negative sentiment. What we haven't seen yet is really that rolling over into some of the harder economic data. So, all the fiscal giveaways definitely supported consumption, and we've seen some tailwinds for that still come through this year. So we haven't seen a kind of collapse in retail activity. Will that come through as interest rates bite into 2023? I think it could well. So, we definitely need to keep an eye on that. I think as well, the absence of China kind of in terms of its global trade footprint, given its zero COVID policy through most of this year, has been incredibly important. And we need to see how the unwinding of that affects Chinese growth, being, the second largest world economy. So, that might be a mitigating factor against some of the fears of slowdown coming in 2023. But it is worth, I guess, we would generally say forecasting macroeconomics is incredibly difficult. So we wouldn't claim here at M&G Investments any particular insights, but we do note that, the Bank of England and the ECB, the European Central Bank, are both expecting material slowdowns in their own growth dynamic on the back of rising rates and the impact on real wages, I think, and how that will affect corporate behavior, cuts in investment and so on. Rising taxes we're starting to see being, a potential feature of those markets.
Right.
So all of that, I think, could come to bear in 2023. Certainly, I think growth is going to slow. The question is whether or not we're going to see an outright recession.